All right, so brand new month, 1st of April, and let's take a look at the markets. So let's begin with the S&P 500. Let's look at the charts to begin with, and then we'll go more into the macro fundamentals. So once again, I always remind students that no one can predict for certainty where the market is going in the short run. We know in the long term, the market always goes up. In the long run, good companies always go up. In the short term, anything can happen. We can't predict for certain. So looking at all these charts basically is based on just probability, what is likely to happen, but it may not happen, right? But again, remember that as investors, our decisions to buy and sell should never be based on predictions, should never be based on where we think the market's going. It should just be based on, is it a good business? Is it undervalued? If it is, we just buy. Very simple. In the long run, they always go up. So I like to say that all these market analysis are more or less for entertainment purposes, and it's not really critical to our investment success. But having said that, it's pretty fun to look at it anyway. Okay, so from the start of the year, we actually started going into this correction phase where the market made, again, lower highs and lower lows. And the 20 EMA crossed below the 40 EMA, signaling a short-term downtrend. And then what happened was last month we had the dreaded 50 moving average crossing below the 150 moving average, which indicates that the medium-term trend is turning downwards. But what was interesting was that in last month's review, we were somewhere here and we were still part of the downtrend. And then we made a low somewhere over here at 4414, and I did release a video saying that, hey, this could be the bottom because of various factors. And one of the factors was that markets were way oversold. The fear and greed index was extreme fear, which usually is an indication that the market has found a temporary bottom. So remember that markets tend to bottom when there's extreme pessimism. When things are extremely oversold, it will tend to reverse back up. As mentioned in my YouTube videos, we had a bit of an oversold pattern on the S&P on the weekly candles. If you take a look at the Williams percentage R 13, we made a very oversold condition over there, and normalized ATR went above the AT level. So this is usually an indication of a bottom within a correction. And we also had a bullish engulfing pattern on the weekly candles. Plus, I also mentioned in the YouTube videos that if you look at the fear and greed index, we actually hit extreme fear, which is anything below that 20 level. And if you look back at recent corrections, every time we hit extreme fear, the market tended to bottom. Market tended to bottom every time extreme fear was hit. And the final chart you can look at, again over here, you can see that whenever the fund managers survey cash levels went up way above 5%. So what does this mean? So fund managers, what happens is that they usually are fully invested and they keep a certain amount of cash in the fund, right? But what happens is when they start to sell, the amount of cash increases. So once there's too much cash in the fund, it means that there's a lot of cash on the sidelines, which can then be reinvested into the market to push the market up again. So whenever you see that the cash levels get way above 5%, like here, it tended to coincide with, again, market bottoms. And what happened in late March, you can see that the cash levels that fund managers were holding went all the way up to almost 6%, which means that a lot of fund managers have already sold, right? And they were sitting on relatively a lot of cash. So once they've got this ammunition, this cash, they put it back into the market, which they have to eventually. That would give ammunition for the market to go up. So all these were kind of like signals that the market was potentially very oversold, potentially at the bottom, and going to reverse back up. So it indeed became that bottom of this current correction, and since then you can see the S&P has actually broken above this trendline resistance. That was a pretty bullish move, right? So it broke above the trendline resistance and closed back above the 200 moving average. So whenever the market closes back above the 200-day moving average, this red line, and the red line continues sloping up, that is a very bullish signal. That tells us that the medium to longer term trend has reversed back up. And not only that, you can see that the 20 EMA has crossed back above the 40 EMA. So technically, we are back on a clear uptrend here, right? And you can see as well from lower highs, you've got higher highs and higher highs, and lower lows and higher lows. So this is definitely a trend reversal over here. Now, again, having said that, it doesn't mean that it can't reverse back down, right? Technicals only tell us where the trend is, when the trend reverses, but it never tells us, it can never predict when it will reverse back down. So for now, we are on a short-term to medium-term uptrend. But like I said in the chat group recently, that after a strong wave up, right? Remember, nothing goes up in a straight line. Wave up, wave down, wave up, wave down. So what happens after a strong wave up? Right? You need a bit of a wave down. And this one was a very minor pullback. Wave up again. And now we're going through a bigger pullback, right? Which is healthy, right? You don't want it to just go 90 degrees. That's really scary. Then it becomes very overextended. So so in the last few days, we had this retracement over here. So where will it retrace back to? That's the question. Again, no one knows, but we look at support levels. Now, we can obviously see a strong support level over here at 4258. So let's watch this level, right? So if we can hold this level for 4528, then this would lead to the next wave up. Now again, of course, it could break below this level and it could find support at the 200 moving average, right, before going up. So we are watching these levels, or can even go back to the 50 moving average before launching back. So no one knows how deep the wave down will be, right? But as long as we stay above the 200-day or 50-day, we can safely assume that this new trend is very much intact until the market decides to reverse back down again. So that's the S&P 500. Now, if you look at the NASDAQ, let's look at what happened to the NASDAQ. Last month, the NASDAQ actually closed below the 20% drawdown level, right? It actually closed below that level. And that was pretty bearish because remember, when a market closes below 20%, it's a bear market. So officially, the NASDAQ is in a bear market. And I mentioned before that historically, every time the NASDAQ went into a bear market, the S&P would go into a bear market. That's why I said, hey, the S&P could be looking at a bear market. But it's really interesting because the S&P has not yet gone into a bear market. In fact, it's quite far from a bear market. It's quite far from the 20% drawdown level. And the NASDAQ also rallied very strongly. So the NASDAQ crossed back above the 50 moving average. The 20 is above the 40. But what's a bit concerning is that the NASDAQ could not break above the 200 moving average. You can see this 200, it could not break above. It hit the 200 and it looks like it could be coming down, right? So if it goes back and closes back down again, well, that would be really bearish. So we got to watch this really, really carefully. But again, if this could again find support somewhere here and launch back up, then that would be bullish again. So again, NASDAQ officially still in the bear market actually, but NASDAQ looks more bullish right now. So there's a bit of divergence going on in the markets. Now, historically speaking, if you look at what we call seasons, April tends to be one of the most bullish months of the year. And usually after a bearish first quarter, there's a high probability that April will tend to continue rallying. Again, that's based on history, right? But we'll see how that goes. So overall, the month of March has been a bullish month. It's been a month where we made back some of the temporary drawdowns from the first 2 months. So March was a bullish month for all sectors. And the most bullish sectors were once again utilities, basic materials, real estate, and energy. So again, I've mentioned before that in the long run, these sectors, they tend to underperform the market, but in the short term, they can outperform, like what's happening now because of the war in Ukraine that's driving up commodity prices and oil prices, and hence causing this short-term outperformance in these sectors. Now, year to date, you can see energy, again, the best performer for the year because of, again, oil prices rising because of the war, and followed by basic materials and utilities. So, like I said, for those of you who find that, hey, you are underperforming the market, no worries. I'm underperforming the market as well, because in most of my portfolio, what do I have? I've got technology companies, consumer discretionary, which is known as consumer cyclical, communication services, healthcare, and financials, right? So because of that, obviously I'll underperform the market because I'm holding the sectors that have been underperforming this year. And that's fine, because in the long run, they will outperform. Recently, I read a very interesting research that showed that over a 10-year period, the best performing money managers over a 10-year period who are able to beat the market in the long run, all of them have underperformed the market for at least 3 years within that 10-year period. Okay, so what does that mean? So that basically means that if you want to be able to beat the market in the long run, sometimes in a short term, even for 1 or 2 or 3 years, you may underperform the market. And what's the reason for that? Because the way to beat the market is basically to go opposite of the market at times, right? To buy things that are undervalued and eventually sell them when they're way overvalued. And to buy things that are undervalued, you have to again go against the market at times. So when you go against the market, short term, you may underperform because of that, but in the long run, you will outperform the market. So like I said, I read in a chat group, some people are saying, oh, I underperformed the market this week or this month, right? So it's too short a time frame. You have to look at the longer term. You hold great companies that will outperform other businesses. Over time, you will outperform. So don't worry too much about the short-term underperformance, because this is what happens. Okay. Now, on the 16th of March, the Fed raised interest rates for the first time in this rate hike cycle. They raised interest rates by 25 basis points, or 0.25%. And what happened to the market? You can see from here, this was the day they raised interest rates. The moment they did, the market rallied, right? So why does that happen? So I've mentioned this many, many times. People think that when the Fed raises interest rates, the stock market goes down. Wrong. If you look at history, every time the Fed raises interest rates, the market actually goes up. Remember, in the long run, the stock market tends to move in the same direction as interest rates. What actually happens is the market tends to go down when they anticipate that the Fed will raise interest rates. But when they actually raise interest rates, the market actually goes up. All right. So why does this happen? And I like to use this analogy. It's like many people, before they go for their examination, back when we were in school, right? We get very nervous. Oh my God, the exam is coming. We get really nervous and anxious, and so-called we go down, right? Our emotions go down, market goes down. But what happens when the examination actually begins and you actually do the exam and you find that, hey, it's not as bad as I thought, and you feel usually more relaxed in the exam hall and you're doing the work and you feel better, right? And it goes up, right? So same thing happens over here, right? Every time they say, hey, Fed's going to raise interest rates, market goes down. When the Fed actually raises rates, markets goes up. So that's how it works. So a lot of people, when they saw that the Fed raised interest rates here and they shorted the market or they sold, they are in for the root short, because that's when markets go up. So let's take a look at this chart over here. Okay. So again, March 16, interest rates were raised by 0.25%. All right. And the Fed projects another 1, 2, 3, 4, 5, 6 more rate hikes for this year, and another more rate hike in January of next year. So we expect 7 more interest rate hikes from 0.25 to 200 basis points. So 200 basis points means 2% short-term interest rates. Now, if you think that's high, if you look at history, is actually relatively very, very low, right? It was not too long ago that short-term interest rates were 6%. That's right, they were 6% not too long ago, and 5-6%, so 2% is still very low from historical standards, right? So for those of you who don't understand why the Fed is raising interest rates, let me do my best to use an analogy. So think of the economy like a car, okay? Now what happens is that when a car is stuck in the mud, like in a recession, you want to move the car forward, you step on the accelerator, you step on the gas, right? So that is the equivalent of the Fed cutting interest rates. When they cut interest rates to stimulate the economy, it's like stepping on the gas and the car gets moving. So that's what happened in March 2020, recession, the Fed cut rates, they stepped on the gas and the car started moving. Now what happens when the car moves too fast? The engine gets overheated, or the driver may lose control of the car because it goes too fast and it can slam into a tree, right? So same thing with the economy. When the economy gets too hot and too strong, you get inflation. So in order to control inflation, to so-called control the economy from going too hot, you have to step on the brakes. So that's what the Fed is doing. They're raising interest rates, like stepping on the brakes to slow the car down. Now, of course, the fear is if you step on the brakes too hard, what happens? The car can stall, right? The economy can go into a recession. That is what people are afraid of, right? But more often than not, what happens is that when you step on the brakes of a car, is because the car is going fast. So what that means is the Fed will raise interest rates as long as the economy remains strong. And that is why an interest rate increase is usually associated with economic growth and actually higher stock prices. All right, so that's basically how it works.